Welcome, focus learners. If you've ever stared at a price chart and felt like, I don't know, you're trying to read a completely foreign language, well, you are in exactly the right place. Our mission in this explainer is to completely demystify candlestick charting. We're going to cut through the confusion, ignore all that market noise, and actually decode the real story that price action is telling us. But before we get to the solutions, we really have to address the elephant in the room. 99%. It's crazy, right? But that is the staggering failure rate of candlestick patterns as they are commonly used. And why is that? It's simply because traders memorize shapes without understanding the underlying mechanics. They're memorizing a picture but completely ignoring the absolute battle happening right behind it. So if almost everything out there is just noise and faulty application, that brings us to a pretty crucial question. Which patterns actually work? Well, today, we are going to filter out that 99% of junk and focus exclusively on the top 6 proven patterns that actually generate a real edge in the market. Here is our quick roadmap for today. We'll start with the fundamentals, comparing candlesticks to line charts. Then, we'll dive right into those top 6 high-probability patterns. After that, we'll cover an advanced strategy combining these patterns with key levels. And we'll wrap it all up with some clear conclusions and action steps you can literally take today. All right, Section 1, Fundamentals, Candlesticks versus Line Charts. Let's see exactly why traditional charts might be holding you back. You see, a standard line chart gives you exactly one piece of information per period, just the closing price. It's kind of like only looking at the final score of a basketball game. It entirely ignores all the intra-game swings, the lead changes, the volatility. In stark contrast, candlestick charts give us 4 crucial data points: the open, the high, the low, and the close, what we often refer to as OHLC data. You literally get the whole game. Let's break down the anatomy of a single candle to see why that actually matters. That solid part in the middle, that's called the body, and it shows you exactly where the price opened and closed. But honestly, the real magic happens in the wick, which some people call the shadow. These wicks show you the absolute highest and lowest prices reached during that specific time frame. Wicks reveal those hidden market rejections. Like, imagine when price dips below a support line but then violently bounces back up before closing. A basic line chart completely ignores that epic battle. And understanding this brilliantly illustrates market momentum. A green candle simply means the buyers won that period. A red candle means the sellers took it. But you really have to look at the sizing. A massive body means one side absolutely dominated the period with very little resistance. A tiny body with long equal wicks, that means a fierce tug-of-war basically ended in a tie. And a long wick on just one side, now that signifies intense pressure and a really sharp rejection by either the buyers or the sellers. Okay, Section 2, the top 6 high-probability patterns. Now that we've got a handle on the language of momentum, it's time to learn the specific patterns that are actually proven to work. First up is the engulfing pattern. Now, this is a 2-candle sequence. Imagine a downtrend, right? You see a smaller red candle, and then suddenly, bam, a massive green candle forms whose body completely swallows or engulfs that previous red body. That's a bullish engulfing pattern. It signals a massive, undeniable shift in dominance, straight from sellers to buyers. And remember, the larger that second candle is, the greater the chance of a truly powerful reversal. Second is the pin bar. This is a single candle setup, and it has a very small body paired with an incredibly long wick on just one side. A bullish pin bar, for example, has a long wick pointing down on the bottom. So why does this matter? Well, because it perfectly visualizes a trap. The sellers pushed the price way down, but then buyers stepped in, entirely rejected that downward move, and basically forced the price back up before the close. It's a striking visual representation of a failed breakout. Let's move to pattern 3 and see how this builds into trend continuation. We call this the 3-bar continuation. Picture a really strong uptrend. You get a large green candle, then a small red candle forms, and crucially, it shouldn't be more than half the size of that first one. Finally, a third, massive green candle smashes right past the second. It shows a strong trend, taking a brief little pause to catch its breath before powerfully resuming its direction. Fourth, we have the 3-bar reversal. Now, this happens when a trend just straight up exhausts itself. Imagine 2 green candles, but the second one is noticeably smaller than the first. You can see momentum is dying. Then, boom, a massive red candle drops out of nowhere, completely wiping out all the previous progress. When the market runs out of steam like that, this specific pattern sparks the reversal. Fifth on our list are breakout candles. Now, this pattern definitely requires some patience. You're going to see multiple small candles clumping together, at least 3, but honestly, the more the better. This is consolidation. The market is stagnant, it's deciding what to do next. Then suddenly, that sideways action is violently shattered by a single definitive breakout candle in one direction. It's exactly like a coiled spring finally releasing all of its pent-up tension. And our 6th proven setup is the shrinking candles pattern. This one is all about spotting weakness before the rest of the crowd does. You want to look for at least 3 candles of the same color, but getting progressively smaller. The trend is literally shrinking in front of you. Just when retail traders think the trend is totally safe, a massive opposite-colored candle springs the trap, confirming a major reversal. Moving right along to Section 3, Advanced Strategy, combining patterns with key levels. Because here is the absolute crucial point. As amazing as these 6 patterns are, if you trade them blindly in the middle of nowhere, you are going to lose. We need to elevate this approach. Welcome to the golden rule of confluence. Now, confluence is just a fancy word for things lining up. You should only ever trade those 6 patterns when they occur at a key level on your chart. This means patiently waiting for the price to hit established support or resistance zones, or maybe a major trend line. When a key structural level perfectly intersects with a high probability candlestick pattern, you've essentially found a prime high win rate entry zone. So here is your exact execution checklist. First step, zoom out. Stick to the 1-hour time frame or higher to filter out all that erratic lower time frame noise. Second, draw out your support, resistance, and trend lines to find those vital confluence zones. Third, just wait. When the price hits that zone, do not try to guess. Wait for one of our top 6 patterns to fully form and confirm the reversal before you ever make your move. All right, Section 4, Conclusion and Action Steps. We have covered a tremendous amount of ground in this explainer today, from the anatomy of a wick all the way to advanced confluence theory. Let's quickly summarize your immediate next moves. Always remember this foundational philosophy. Every single candle is a visual tug-of-war. You see, the market isn't just random math. It is an intense, emotional battle between buyers and sellers. The shapes, the bodies, the wicks, they are simply telling you who is winning that exact battle at any given moment. Your homework here is absolutely critical. Do not risk a single real dollar in live trading yet. Open up historical charts on your preferred platform. Practice identifying the open, high, low, and close. Scroll back in time and try to spot those engulfing patterns. The pin bars, the shrinking candles. Draw your support and resistance lines and really see how the price reacted when those patterns formed at those exact levels of confluence. It definitely takes time to learn a new language, right? But once you can truly read the story of price action, everything changes. So I leave you with this final thought. Are you ready to stop guessing, stop hoping, and start actually trading the undeniable story the charts are telling you? Keep studying, keep analyzing those wicks, and we'll see you in the next explainer.